And this is kind of the wacky accounting that I was talking to you about earlier. But we're going to go over a little bit of the background and kind of what some of the funds are. So, what do I call this thing? Well, accounts for governmental accounting. I don't know why I don't have it matched up on here. But anyway, this should be the accounts for governmental accounting. I have no excuses why I don't have this labeled correctly. Well, let me save it though. Oh, I already have it. I am going to learn how to use a computer if it kills me. All right, let's see here. There we go. Okay, so if you look for the one that says types of funds, we'll go over first. Okay, so fund accounting, there can be a whole bunch of different funds in government, even a small government will a lot of times have a whole bunch of different funds in it. And so I'm just gonna go over briefly just kind of the types of stuff you'll see for different funds. The one that we're going to mostly focus on in this class is going to be this general fund. And the general fund can include a bunch of other separate funds in there. You have the administrative, you know, like the mayor's office and all that kind of stuff. Finance people, etc. And then a lot of the other stuff though that will be in there would be things like the building department. For instance, for building permits. Education. Schools, that sort of thing. Safety. Streets and sanitation. Library. I can't remember. But anyway, yeah, though the point is that there could be many different groups that kind of fall under this general funds that are separate from it, but are basically under the same kind of umbrella. And this is, when you think about governmental accounting, this is probably most of what you think about, the general fund. Okay, special revenue funds. It's probably important to know what a special revenue is. Special revenues are only earned when they are spent for the required purpose. I'll give you an example here in a second. Oops. Example, gas taxes can only be used for street repair. So for instance, if a certain amount of gas taxes are collected, and those can only be used for street repair, and until you use them for street repair, they're not earned. And they can be a little bit of a hassle in a way, in that you say, okay, we got these gas is for street repair. We really don't need it for street repair. We need it for education or the library or something. But special revenue funds can only be used for a required purpose. So if it's and they'll get audited. When they get audited, they will look to see that these funds were used for the appropriate purpose. If they weren't, then the funds disappear. They weren't used for the appropriate purpose. They're not earned, and they will be returned. So things like gas tax is one of those things. There could be other things. Sometimes people will donate money and so forth that can only be used for certain things. That usually falls down here, but the idea is exactly the same, is that the purpose for it is restricted. So special revenue funds are funds that keep track of. So if there's a gas tax fund, it will be only when it's used for street repairs. And notice that this will be funding, these can all be used for different, none of these are, necessarily clean, in that it could be that this, it can only be used for street repair, so that any money collected from that fund would then be transferred to streets and sanitation, most likely, to spend that money. But that's a special revenue fund. Streets and sanitation can get money from the special revenue fund. They can get it from taxes. They can get it from all kinds of places, but one of the places they get from is the special revenue fund. Debt service fund. I'll tell you something very unusual about governmental accounting. Long-term debt is not in the general fund. Nothing long-term is in the general fund. The general fund only has current items. It's like a checkbook. So anything long-term goes into a long-term service fund. And what will happen is, so for instance, the government issues bonds to pay for a new library. Those bonds are long-term. Those bonds are not in the general fund. Those bonds will be put in this long-term service fund, and the general fund will transfer money to the long-term service fund to pay off those. Wacky, huh? The long-term debt is not in the general fund. So it isn't that they don't pay off the long-term debt, they do, but it gets transferred from the general fund to the debt service fund to pay that off. Okay, capital projects fund. This is for construction. So they'll vote on, say, building a new bridge. I live in Brookfield. We got this bridge that they've been working on for like a year. I think there's a lot more to it. They actually stopped the creek and diverted all the water around it to build. I don't know what to do, but anyway, it's a construction cost. So they'll have a special fund set up. It's called the Capital Projects Fund for that building of that bridge. When it's done, that capital project fund will, for the bridge, will be closed because it'll, you know, accumulate all the costs in there. And if there's any money left over, it'll go back probably to the general fund, but all those construction costs will be kept together to make sure that it's on budget and all that kind of stuff. But the construction costs will be accumulated in these funds and closed when it's done. So it's going to accumulate all the costs, and then it's going to be closed once it's completed. And normally you say, oh, well, they just completed this construction. It's a bridge. That's a, you know, some kind of an asset, right? Long term, you expect the bridge to last. It's not going to go in the general fund. General fund only has current assets. You will not find a bridge in the general fund. So this is construction costs. The costs are accumulated, and the fund is closed when complete. Permanent funds. These are generally going to be is when funds that let's say permanent funds. What it usually comes down to is someone donating either an investment or money with the interest or income from the investment being used for a specific purpose. So for instance, someone, a lot of times it's when someone passes away, they set up this fund, and whoever died really liked the library, and they want this fund to only be used for buying new library books. So they will set up a fund. And oops. So that'd be an example. Oops. And they call it a permanent fund because the actual amount that's invested never gets used up. It's only the income that comes off of it. And if they have a bad year and there's no income, then nothing's spent out of it. So permanent funds are permanent. They don't spend them all up. These other funds are not permanent. You know, the general fund, you get a new budget every year. You know, these other ones are the same way. You know, a new budget. Yeah, this one's the long term. This will be longer. Capital projects fund can be, you know, long term, and go on for several years, but at some point they're going to close out. But these permanent funds are, at least theoretically, there forever. Any questions on that? Okay, I think that's probably enough for that. Let me see. Get this other stuff. We can get bogged down on this other stuff here. Well, I got something else to show you for these, anyways. Okay. This is what I really came here to talk about today. Okay, so get to this part where it says initial estimate budget at the beginning of the year. A. So I think we talked a little about this last class, but so here you are, you're a mayor, a new mayor, old mayor, whatever. You come in and you fight over the budget, you get the budget worked out, and then when it comes time to start the year, you put your budget on the books, your legal budget on the books. So, you fight and get, whatever the taxes are going to be and who gets what. And, we did the thing with the police cars and all that kind of stuff. So you get all that fighting out of the way, and then now you got to put your budget on the books. And so this first journal entry we're going to do is for putting the budget on the books, and it's kind of a strange entry. So let's take a look, see at what it is. Okay, first things first. Usually, most state and local governments have a July 1st through June 30th year. Not all of them, but most of them do. Like I said, usually they have elections in, say, February or March, and then that gives whoever's coming in or whoever's still in and was reelected, that gives them time to get their budget together. And then on July 1st, they start the new fiscal year for the government agency. So usually it's July 1st through June 30th. And by the way, this works out really well for CPA firms because they do auditing, and most of their clients are year end or 12/31. So it's nice to have, if they do governmental accounting, they do the audits. It's nice to mix in a few government agencies because they can do these not all at January 1st, but kind of spread them out the work throughout the year. Okay, estimated incoming money. So you're going to estimate what money you're going to get in. So estimating the revenues, taxes, fees, tickets, sales, etc. It's possible that you need to get money from selling bonds. Other financing sources transfer in. A lot of times this is from other funds. For instance, maybe the state has grants of $100,000 if you to use for upgrading your fire department. That would be an estimate of other funds being transferred in from another fund. It's not a revenue, and it's not like you're making money through selling tickets or something like that. It's just simply money that's being transferred from one fund to another, and any other financing sources. Here's the wacky thing about this. Oops. These estimated revenues come in as debits. And that's a little bit wacky. And it's wacky because revenues are generally credits. Revenues decrease with debits. So revenues are usually credits. And in fact, if you had me in accounting, what was it, 210? I'll tell you, when you see revenue, it's a credit because very rarely do they go down. They're virtually always as credits. So, revenues are credits. Okay, so this is a debit. That's kind of strange. What the budget entry is, it's sort of like a closing entry done at the first day of the year. So it's sort of like, hey, if everything goes on the way we plan it, this is going to be our closing entry. We're going to close out the revenues and all that with a debit. Through the year, we'll have credits in this account, and when we close it up. Now, if we hit it right on the head, it'll be exactly the same. It usually doesn't happen that way, but it's sort of like a closing entry done on the first day of the year. Again, this is something that you'll never see in GAAP, but they make budgets. Don't get me wrong; companies make budgets all the time, but they don't put it on the books. This is put on the books because this is a legal thing. So this is the money coming in. This is the incoming money. Oops. And down here is the outgoing money. And the weird thing is, these are credits. Usually when expenses go up, they're debits. These are going to be credits. Again, this thing is like a closing entry done on the first day of the year. So if you're thinking, hey, these debits and credits are reversed, you're right. They are. Okay. What do we call what we're going to set aside for spending? We call those appropriations, and this is an important term. They are the estimated expenditures. However, do not call them estimated expenditures on the CPA exam. I've seen CPA exam questions where they say which one of these is not an account, and it's estimated expenditures. They're called appropriations. I don't know why they get so crazy about it, but appropriations are your estimated expenditures. However, don't say that on the CPA exam. They're just appropriations. Okay, and sort of the opposite of up here, where we have estimated transfers in, we also may have estimated transfers out. So, for instance, we might pay the debt service fund. Yeah, it's also say debt service. That'd be an example of something. We say, okay, well, we have to pay off some of these bonds. So we'll say, okay, we're going to pay off 30,000 of these bonds, or we have to pay interest on 30,000, whatever it is. We have to set aside money. Say, okay, well, look, we have to put this in the debt service fund so that they can pay off these bonds that we owe on. Because remember, the bonds are not in the general fund. And other ones, whatever else you want to use the other financing for. Budgetary fund balance. This is a plug number, and this is what you use per the AICPA. So when you take the CPA exam, that is the account you're going to use. This is the account we're going to use in this class. The budgetary fund balance. I know that other places use fund balance unassigned, but that's not according to the AICPA. The AICPA, they say it must be called the budgetary fund balance. So the budgetary fund balance is the term you need to use. So, according to the AICPA, the two big things as far as the nomenclature here is appropriations, not estimated expenditures, even though that's what they are. Appropriations and budgetary fund balance. So budgetary fund balance and appropriations, those are the key terms that they get kind of crazy about. Okay. I'll get into this later. The stuff down here. Okay, let's do our journal entry here. Okay, so let's go back to this general fund one. And what we're going to do is put each of these in, and again, it's a little bit kind of wacky because the revenues, the money coming in, are debits, and the money going out are credits, and whatever's left over here will be a debit or credit. But so the incoming money are going to be debits, the outgoing is going to be credits. It's like opposite day, and then whatever's left over will be the fund balance. It's literally is like a closing entry done on the first day of the year. Okay, so estimated revenue is going to be our first debit. $160,000. Estimated other financing source bond issue. You could abbreviate that. This is sometimes abbreviated as for the other financing source. You see OFS. I'm going to write it out just so that we kind of know what's going on here. $30,000. Okay, so this is money we're estimating is coming in. Now we go to money we estimate is going out. Appropriations. That's not how you spell it. Appropriations, 164,000. And it's been other financing uses. And I almost hesitate putting this one up, but this is what they abbreviated it as. So other financing uses. And this is transfers out. So probably we're going to transfer some money to someone else, maybe library or something like that. $22,000. Okay, I'm gonna insert a row. Now we need a plug number, so we gotta know what's on this side and what's on the other side. So let's see, this is what, 190,000. I'm just gonna make those in red so we know that they're not part of the journal entry. And this over here is 186. Okay, so what do we need to make this balance? We got 190,000 on the debits, 186,000 on the credits. So to make this balance, what do we need?
4,000 in credits.
Yep. And so that's going to be our budgetary fund balance. So we need $4,000 to make this balance, and this is a plug number. It's a plug number, but it's also kind of an important one, and I'll tell you why in a second. Get rid of those two now. To be a legal budget, you have to be able to cover your, you have to have enough in your fund balance to cover it. And if you, so this it would be definitely a legal budget because they're bringing in 190,000, they're paying out 186. So if everything goes right, the budgetary fund balance should go up by 4,000. Now the question is, what if instead of being a debit, what if that was a credit? What if you had more estimated expenditures and transfers out than you could cover with your revenues? That's okay as long as you have fund balance to cover it. It's a legal budget if you have a fund balance to cover it. If you don't have a fund balance to cover that gap, then it's not legal. So, and this is one of the reasons why we have this on the books, is that there is a requirement that they have a legal balanced budget. That it's a legal thing. I don't know if anyone's gone to jail or something. If they, I guess there could be gross negligence or something. But generally speaking, though, it is a legal thing that you have to have this balanced budget. Different than the federal government. The federal government can have deficits. Generally speaking, state and local governments cannot do that. You have to have some way of showing that they can, come up with the money. So this is a plug number here. But in this case, it does show, we don't know what the fund balance is, but it doesn't really matter because this will definitely cover whatever the fund balance is. It'll cover plus 4,000. So they have enough for the next year. Okay, let's go on to this one and I'll be quiet and see if you guys can figure this one out. Okay, so I think that we should have gotten, now this budgetary fund balance, you'll notice that this is, in the current budget, it's a deficit. Now, as long as they have at least $50,000 in the fund balance from previous years, it's still okay to run this. This will be a balanced budget. My sister had their township had something like 4 years of a budget surplus. People got kind of mad. They said, okay, you gotta start, reducing your taxes and spending some of this money. So anyway, their budgets would not be balanced up because they would be trying to spend down their surplus, because it was, people started to complain about it. You're taking all our money and you're not doing anything with it. So anyway, this is what the account would look like. Again, this is a plug number to make the two sides equal. Okay. This journal entry is made, it's on the books. However, it does not appear on any financial statement because it never really happened. Okay, so they put this on the books and they'll use this for comparison as the year goes on, saying, okay, we can only spend so much. This is what our budget is, this is what we think we're going to come in, and all that kind of stuff. It'll sit on the books and they'll use it for comparison and to see where they have to cut back or see where they can spend more money. For instance, it's very hard for someone to a town to predict how much snowfall they're going to get. Some years we get clobbered, we get tons of snow, and they have to use gas for the plows and salt and all that kind of stuff. On the other hand, some years we don't get anything, so they have all this money budgeted for salt, and they go, okay, well, we got all this money that's just sitting there for salt, and again, this budget is for 1 year. And so if they really need the money someplace else, they might say, okay, well, here, I tell you what, we'll take some of this money and use it for education or whatever. So there are adjustments that are made, but they'll use this kind of as a guideline as they go throughout the year to see what they're spending and to make sure that they try to stick to it as closely as possible. Okay. Property tax revenue. We'll do this one. I think we'll take a break. I know this stuff's a little bit dry. Okay, here's some of the stuff for, I gotta come down here. Most cities are funded through property tax revenue. And most government, we think about accounting in general, you go, okay, revenues are when you earn. You guys are told that from day one in accounting that, okay, when the money is earned, you count it as a revenue, not until, right? We kind of throw that out the window though when it comes to governmental accounting, because we're not really giving anyone anything back. When you pay your property taxes, it isn't like they come back and you pay whatever. It's like you pay $5,000 in property tax and they come back and give you a boat or something. You pay the money in and it goes to things like schools and streets and libraries and all this other stuff, right? So it's not like a normal business and that you don't really have income. That's not really the goal of it. So when you talk about revenues, what you're really talking about is when you can recognize when can you recognize these revenues. And for property taxes, it's when you levy them. When you levy the property taxes that you can then, once they're estimated and they're levied, that's when you can pick that up as revenue. It's not earned in the normal sense that we think of earning anything. Okay. Another thing about the property tax revenue is why it is, I think I talked about this before, but why states and local governments love them is you can generally use them for whatever you want. Unlike, say, special revenue funds, that you get for gas, the gas tax, you can only spend it on the streets. The general fund stuff, the property tax stuff, you can generally use that on whatever you want. Okay, if the streets need more money, we would more money in the street. If the library needs more money, we get the library. It's very flexible. It's money that is highly prized because it isn't restricted as far as what you can use it for. So that's one of the reasons why not only is it a bulk of what they spend, but also they like it because it's so flexible. So property tax revenue is recognized when it is levied. The revenues are recognized for the current year plus 60 days. Those that are in excess of 60 days are what's called unavailable revenues. This is sort of like a here's why it's saying that. It's saying, okay, up to 60 days you collect something, you're probably still using that money to pay off bills for the previous period. You levied this tax in, say, 2021, 2022, end of the year, it starts going into 60 days into the next year. That money that you collect after 60 days is probably going to go towards paying off stuff in the following year. So this is a revenue that, even though we count it as a revenue because we levied the taxes, it's really going to be put into another year, into the next year, even though we levied it in the current year. So this unavailable revenue is kind of just what it says. It's not going to be available until after 60 days into the next year. So it's going to go into 2022. Okay. I'm not sure why I didn't make this into a journal entry looking thing. It'll look like that. Okay. So let's do this. So taxes receivable. So this will be for the entire amount. So let's take a look, see here. So the total property taxes levied were for 280,000. It's estimated that 15% of the, or 15,000 of these taxes will be levied will be uncollectible, and that 20,000 tax levy will not be collected until 60 days into the next year. Okay, so we put on the books the entire taxes receivable, probably property taxes receivable, a better way to put it. Hold on, what do I have in the handout? How do I have it in the handout? Taxes receivable? Okay, we'll leave it at that. Oops. So 280,000. We're going to have some of these we don't plan on collecting. Oops. Right. I'm just gonna say current, how about? Oops. Now, we also have this unavailable revenue, and this is for stuff that we're not going to collect within this year plus 60 days into the next. It's not really unearned revenue because you haven't actually collected it yet. And so this will be revenue in the current year. Whatever is left over. 280, 245. So this is really, out of all of this is what we think we're going to collect. And we will book that as regular revenue, even though we don't have any of it coming in yet. We just made the levy, the tax levy. But we think we're not going to collect 15,000 of it. Because, you know, people die, people move away, people leave the country, you know, all kinds of stuff can happen. People lose their job, they go bankrupt, whatever, that you're not going to collect all of it. So we put that estimated uncollectible, we take that off because we're not going to collect that this year. And then the stuff that we're not going to collect within the next 60 days at the end of the year, we also say, okay, this, while we're levying it, you know, it's levied for this year's taxes, it's not going to be available to us for this year. It'll be available for future years. So that's what that would look like. And so this would not be usable in this year. This would go on to the following year. See if you can figure this one out. You're gonna have to do a little math here because we got these, they're using percentages instead of dollars, but I think you guys can handle that. So see if you can make that journal entry. Okay, so I think this is what you should come up with. Maybe I'll check my numbers, but 3% of the taxes will be uncollectible, so that's 3% is this. And at 2%, let me change the color here. Will not be collected until 60 days after. Oops. Let's try that again. So I think the revenue should be 475,000. And again, the kind of weird thing about it is that, you know, it's not a business. You know, it isn't like we gave them any services or anything like that. It's whenever you send the bill out, you count it as revenue. Whenever you can, the amount is known, that it's estimable, and that you have sent out the tax levies, that you put it on the books. So it's different than what we normally think about in revenues. And, you know, in regular accounting, we get really, you know, it's got to be earned, and there's, you know, all these hoops to jump through. Whereas it's not really like that for governmental accounting, because it's not a profit motivation, and they're not giving anything tangible in return for the money coming in. Okay, let's go ahead and take a break here. Let's say, any questions on this? Okay, let's say be back at what time is it? I want to say be back at 7:05. How about? Okay, we'll go through finishing up the revenue, the next page, and let's go ahead and do that. Okay, this first journal entry is going to be just like the ones that we just did. So we're going to pick up the, well, let's take a look here. So property tax, we're levying an amount of 400,000. The sump pump here keeps going off in the basement. Okay, so tax limiting recurrence. 400,000. 10,000 will be uncollectible. $10,000. All the net taxes will be collected within 60 days of the year end. Okay, so we don't have any of the taxes we can't spend. So we'll have revenues. So we have all of them except for this, the unavailable. Okay, now for the tough part. As of June 30th, 365,000 of the property taxes had been collected. So they collected that, and that's going to be cash. So what will the journal entry be? So we collected 365,000 was collected, and it was in cash. Sorry about that. So what's the journal entry going to look like? So here we levy the taxes of 400,000. We collected 365,000 in cash. So what's the journal entry going to be? Sorry, I got to sneeze again. Okay, I'm back. So what's the journal entry going to be? Anyone? Well, first of all, we're going to take off some of this off the books, right? Because it's no longer taxes receivable. We've already received it. Oops, nice little taxes. We only got half a journal entry though. What's going to be on the other side?
Would be a
Just cash.
deferred.
Yeah, cash. Yeah, so our cash asset going up. Still have it up here? I do. Yeah, so this would be cash, increase with a debit. You know what, actually, down here. Cash is an asset, increase with a debit. Oops, wrong one. Here we go. All right, so we've collected 365. And now for the very confusing thing. The taxes receivable current will now turn into taxes receivable delinquent. And we also have to take the estimate. You know, I think I might skip this part. I am going to skip this part. I'll tell you about it, and if you, I'll put it up later on to, if you want to complete it. But basically, you rename everything that was current into delinquent. So if we tax receivable delinquent, that's because it was for the previous year. So going into the next year, you'll know, okay, that's not for this year. That's not the current year. That's delinquent from the previous year. So those collections that are made after will be in delinquent. There might also be fines and penalties that you charge on that delinquent taxes, which would be additional revenue. But and the more I think about it, it's probably not as important as some of the other stuff we have here. I'll put it up in next week, and I'll show you guys, you know, the completed part of it, just to kind of show you what it is. But yeah, you basically just go through and rename them. So, you know, this would, oops, whatever's left over in here, which would be what, 35,000. You would put a journal entry in to change this from tax receivable current to tax receivable delinquent. Okay. Now, it is possible just to have plain old cash revenues. Now, oops. So we have building permits. We have, this is number 7. So skip down to number 7 if you would. So we have building permits, we have miscellaneous city fees, general fund, and tickets and fines, public safety. So these are all cash that was collected. And as of August 31st. Now here's a question for you. So let's say building permits. Why didn't we put 80,000 of building permits on at the beginning of the year? You know, we put the property tax put on the books at whatever it was. But we didn't put anything on for building permits or any of these other ones or tickets or anything like that. Why not? You know, what's different about those? What's different about the property, you mean the property tax and let's say building permits?
The building permits, you collect them throughout the year, and the tax levy, you actually have to do it on a yearly basis. I mean,
Yeah, and you don't even know what right, you won't even know what it's going to be yet, right? I mean, you know, some people may, you know, they may have more 1 year, whatever. There's nothing to kind of accrue here because until they pay it to you, you don't know what you're going to clear. So you can do these separately, and I would probably encourage you to do it separately. I'll tell you why in a second, but you just pick up the cash. So 80,000. You might put what it's for. Going into accounting, I'll tell you guys, the more that you put in, the less hassle it is later on. And I'll tell you why I'm doing it this way for putting them in separately also. Oops. Oh, city fees. Okay, I'll tell you why it's a good habit to get into if you're going to be in accounting, to when you do journal entries, something like this. It's a good idea to try to keep them separate. It just makes things, it'll make your life a lot easier later on. Invariably, someone's going to ask you, if you lump these all together and put them in as one journal entry for whatever it is, 166,000. There's nothing wrong with doing that. Theoretically, putting it in as cash 166,000, revenues 166,000. There's nothing wrong with doing that. However, invariably someone's going to ask you, well, what about the 80,000? Whatever that we collected for this, and I don't see it. I don't see the 80,000 there. So going back to the journal entries, if you can separate it out, if you can put it, say, okay, well, here's the revenue, and then here it is in cash. If you separate it out, it just makes it a lot easier. And a lot of times you won't get, what I would call maybe the, I don't say silly question, but people will just ask questions about stuff all the time, about this kind of stuff. And if you put them in separately, it's real easy to explain it. And quite honestly, you probably won't have to explain it because they'll be able to see it. The transactions and so forth. So it really is saving yourself time by putting these things in separately, and especially things that you can point to the cash and say, well, here's the cash for the building permits. They went in on this date, and this is 80,000. Here's the 80,000. Or if you lump them all together, you won't be able to save that. All right. Any question on that? So anyway, that's just feed your dog chicken bones, one of those kind of things. But generally, if you split it up separately, it usually saves questions from people later on. Okay, purchases. Now we're going to get really, really, really wacky. Okay. And this has to do with the fact that we have a checkbook that has a certain amount in it for the entire year. When a purchase order is made, you have to have some, notice in normal accounting, when you make a purchase order, you don't make any journal entry for it. So if I order a computer, I don't make any journal entry for it because at that point, I don't have the computer yet. They haven't sent me anything. We don't owe anything. No transaction has actually happened when you make the purchase order, right? Until they send the computer, you don't owe them anything, whoever you bought it from. In governmental accounting, it's kind of a different approach in that if you buy a computer, you got to tell everybody, look, don't spend this money because I've already spent this money on a computer, right? So you put your hand on the money. Basically, you take a certain whatever money is on the purchase order, you'll put your hand on that money, and that tells everybody, look, you can't spend this. We can't have the same people spending the same money 2-3 times or whatever. You put your hand on the money and say, okay, this money is reserved for this purchase order, and you can't use it. When the purchase order comes in, then we put it on as a regular transaction. Take our hand off the money, put it on as a regular transaction. But until that happens, we have to put our hand on the money so that people know not to spend that money. So that's kind of the whole idea behind what we're going to do next. So this is the journal entry that we use when we make a purchase order. We put on an encumbrance on the books, usually put the year in, and encumbrances outstanding. And this is simply a budgetary account. These do not go on any financial statements. You may say, well, is that an asset or a liability or what is it? It's nothing. It's a budgetary account. It hasn't happened. So encumbrances do not go on any financial statements, but we still make them because we have to put our hand on the money so that people spending the money will say, oh, wait, oh, this money's all encumbered. I can't spend this money because it's already been spoken for. So it's kind of like putting your hand on the money, and then when it does come through, you take your hand off and then put it through as a regular expenditure. Okay, so let's go ahead and put encumbrances and encumbrances outstanding on the books. Okay, so here we go. We on September 1st, a purchase truck was orders placed for 2 pickup trucks. Estimated cost of the truck is as follows. Okay, so that's on September 1st. I'm going to color coordinate these. So here's September 1st. On October 8th, let's make that green. The truck was received and it was paid for on November 1st. So I'm going to kind of back up here a little bit so you can kind of see. I left a lot of space in here, didn't I? Okay, so on September 1st, we made this purchase order of these 2 trucks. So we're going to put these on the books. Okay, so this purchase order is for $94,000. Okay, so we are going to have encumbrances. Give me a year here. Does not. I'll say 2022 for 94,000. And encumbrances outstanding. Okay, so what we've done is we have put our hand on 94,000 for these this purchase order for these 2 trucks. So someone looking at this will say, okay, there's $94,000. I can't spend that because this is someone has already spent this money, even though no transactions actually happened yet. You know, on 9/3, we made the purchase order, but until they send us a truck, we don't owe them anything. You know, so, you know, it's kind of important, you know, to think about that. This is even though this purchase order was made, there actually is no transaction yet. Excuse me. Okay, on October 8th, the pickup truck is received at a total cost of $53,701. Okay. The first thing we have to do is take our hand off the encumbrance for that truck. We encumbered $53,000 for that truck, so we have to take it off the books. Or 53,000. We're going to take it off the books at what we put it on the books at. So one thing here, we put our hand on 53,000. That's what the purchase order is for. It came in, it's a little bit more than 53,000, but we're going to take our hand off the 53,000 because we put our hand on that 53,000. Well, now we're going to actually spend that money. It's going to show up as a accounts payable or a vouchers payable, which we'll talk about in a second. They're the same thing. But anyway, we put our hand on 53,000, so we're going to take our hand off the 53,000, and then we're going to put it on the books for what it actually was, 53 whatever. Okay, so this was on the books. This came on for 53,701. Okay, now let's go back to our weird thing here. Anything that we spend, we just call an expenditure. Oh, here I got a date on these, 2021. So the expenditures are what we call everything. If we buy a stapler, it's an expenditure. If we pay for landscaping, it's an expenditure. If we buy a new building for $20 million, it's an expenditure. Everything is just an expenditure. It does not go on the books. And fund accounting, we don't have any long-term assets. There is no truck in our checkbook. It's just expenditure. So back to our problem here. So we're going to have an expenditure. We'll probably put what it's for. Maybe a pickup truck. $92, whatever that means. But it's just an expenditure for 53,001. And normally we have an accounts payable. They generally use a vouchers payable, which is the same thing. I just probably talk about vouchers payable here, but the same thing as accounts payable. I should say you can abbreviate this as VP, but it's like an accounts payable, same thing. Okay. On November 1st, we paid for the truck. So how much did we pay for the truck? Anyone? How much did we pay for the truck?
53,701.
Yep. So we're going to pay this vouchers payable, which is the same thing as an accounts payable. And again, you can feel free to abbreviate it VP. Oops, not VV, VP. And what do we probably pay them with?
Expense account?
Well, it's an expenditure account actually, but what do we actually pay them with? When do we send them?
Purchase order?
Nope. We owe them 53,000. Think about it as like an accounts payable. So 53,000 we owe somebody. Well, what's the only way to?
Check.
Yeah, put it, give cash, right? Cash. Oops.
Yeah.
So cash is an asset going down. But yeah, so the weird part is, you know, this is the kind of the weird thing is it's whatever you spend, anything you spend on is going to be an expenditure. You know, again, this could be if it's a phone bill, it's an expenditure. If it's a truck, it's an expenditure. Anything's an expenditure. And again, it goes back to just being like a checkbook. And one of the weird things too that we'll find out later is that they generally categorize, at least for the government wide. If you look at an income statement for most companies, those have revenue will be one line, maybe two lines. You know, if you look at the, you know, for instance, if you look at a motor company, like General Motors, whatever, they'll have revenues will be the, you know, the first big line. That's with them selling cars. They might have some financing, but usually one or two lines for revenues. And then they have a whole bunch of expenses. It's just the opposite for government accounting. Those have expenditures, you know, one number. Here's a whole bunch of revenues and how we covered this one expenditure. You know, so it's a different way of thinking. You know, the expenditures are all lumped together. This is what we spent. Okay, how did you come up with that? That's, you know, the main part of it. Okay. So much, yeah, I should probably talk about vouchers payable. Vouchers payable and accounts payable are basically exactly the same thing, with one exception, and that is that it's when it's approved. I suppose an accounts payable becomes a vouchers payable. It has to do with matching up documents. And these are the documents you need to, by the way, this isn't just for governmental accounting, this is for anything. What's going on here? I don't know what I do here. I did something wrong. Apologies for the clumsy formatting here. So before you pay anything, you first make a purchase order. And the purchase order is just that I ordered this. It doesn't say that they sent anything yet. The receiving report is when they receive it, our receiving department will make a receiving report. Hey, we got this one pickup truck in, right? So the receiving department will receive it and they'll make a receiving report. So the second thing we match up is a receiving report. And I'm just going to do this. And the third thing we need is the vendor invoice. And the vendor invoice should generally match up with the purchase order. It might not match up exactly. It really depends how it was written. But you know, if it's written for an estimated amount, it might not be exactly, but it should be pretty close to it. So, you know, until you get the vendor invoice, you're not even sure how much they're asking for it exactly until you get the invoice. So you have to match those things up. Purchase order, did we order it? Receiving report, did we receive it? And then the invoice will tell us how much that paid. So those things all have to be matched up. When they are matched up, it goes from being an accounts payable to being a vouchers payable. And those three things are all canceled. The purchase order is then canceled because we don't want them sending 2 of the same pickup truck. The receiving report is canceled because it matches up with that purchase order, and the invoice is then canceled. So we don't pay, and those are all 3 cancels, so we don't pay it twice. Once those 3 are all canceled, it goes into a vouchers payable. And the vouchers payable then goes into the system and it will automatically be paid. You do the exact same thing with accounts payable, except that you don't set up the second account of vouchers payable. Now, many businesses use vouchers payable. As time goes on, they'll get the 3 reports. Once you get the 3 reports together, they'll make a vouchers payable, and that voucher payable is approved to get paid. But you'll do the same thing for what they call accounts payable or vouchers payable. It's matching up those 3 things. Did you order it? You don't, because sometimes people will just send you something and then send you a bill. Did you order it? Did you receive it? And then lastly, what was the invoice? How much did they charge you for that item, whatever it was? So those 3 things get matched up, and that's when vouchers payable. It's exactly the same as an accounts payable. What am I doing here? Oops. Okay, let's be the last thing we do. Let's do number 9. We'll do number 9. I'll be quiet and see if you guys can figure out what to do with number 9. And you can't see my screen because I'm a knucklehead. There we go. So go to number 9 and see if you can do the journal entries for that one. Oops, oops, oops. Okay, so I think this is what you should have gotten for that. So we put our hand on the money here. So we made this purchase order and we told people, look, don't spend this money. It's already been spent. And, you know, don't spend it twice. When it comes in, we take our hand off the money. Now, we only took our hand off the money for those things that came in. The large dust did not come in, so we only take off for what we had our hand on. So the cost was $1,158. The actual cost was a little bit less, $1,125. So that's what we put on the books. And again, it's just an expenditure. Anything else, expenditure. You might put a description as far as what it was, but it's just in the money going out. And then we pay out the vouchers payable with cash. A very appropriate question is, well, what about this? What about this large gray desk? You know, that didn't show up. What do we do with that? Okay, that expenditure, that encumbrance will stay on the books. If you plan on receiving that large gray desk, it'll stay on the books until you receive it, even if it goes into a following year. It may go into the following year and say, okay, you know, yeah, we want the desk. Well, we can't, you know, we're not going to get those in for another 8 months. It'll be in the next year. Okay, well, we still want the desk. Well, now, if you cancel it, then you simply reverse out the encumbrance. Take your hand off the money. Say, okay, you know, we didn't get the desk. We went and bought the desk at, you know, Home Depot or whatever, you know, some other place. At that point, you could just take it off the encumbrance, and you know, as long as the purchase order is canceled, take it off completely. But if you are planning on receiving it, though, you can still keep an encumbrance going into the next year. And remember, these encumbrances are not on the financial statement, so it's not going to matter as far as the financial statements whether this encumbrance is there or not. It's simply putting your hand on the money and saying you can't spend this because, you know, this thing's coming in. Weird, huh? Completely different than what we're used to doing. But yeah, so that's the new wacky accounting. Any questions on that? This one's, you know, we're going to do more of these. Obviously, it takes a little while to see it used to them. And I think I mentioned before that there's actually a big need for governmental accounting stuff. So, you know, if you're looking for a career, it's not a bad one to go into, and you know, it's not going to go away. It's not, you know, some businesses will disappear. Right? I worked for a steel company that's, you know, a fraction of the size it was then, and I worked for Navistar, which I think is a smaller company now too. But you know, government's going to be around, so it's not a bad career to go into. And from what I understand, is there's a big need for governmental accounting. Okay, question on that? Okay, nothing to turn in this week. We will wait wait and put here that we stop. And we'll pick it up next time. Questions? Okay, have a good week, and I will talk to you guys in a week's time. Good night.
Thank you.
Thank you.
Good night.